Assalamualaikum to our respected lecturer, Dr. Nuraidah, and our beloved friends. Today, our group, which is Group 1, will presenting the financial statement analysis of Padini Holding Berhad for year 2024 and 2025. Before we start, I will introduce our group members, which is me, myself, NURAZRINAZ binti AZMAN, HAKIMI bin AMINUDDin, HAZIQAH binti IDRIS, and RAUDAH binti MOHAMMAD. First of all, I will briefly share the background of Padini Holdings Berhad. Padini was founded in 1971 as a small clothing business in Malaysia. It started by supplying clothes to department stores, and over time, it grew into a well-known fashion company. Padini expanded from manufacturing into retailing its own brand through dedicated stores. Today, Padini owns and manages many popular fashion brands such as Padini, BINTI, Mickey, and others, which cater to different customer needs, style, and price range. The company offers fashion products for men and women of all ages through its Padini concept store and brand outlet store. Padini also is listed on Bursa Malaysia and operates many stores in Malaysia and other countries as well as online globally. Overall, Padini has grown into one of Malaysia's leading fashion companies in the clothing industry. So next, I'm going to talk about financial ratio analysis. Basically, financial ratio analysis helps us understand a company's financial situation in a simpler way. It breaks down complicated financial numbers into easy to understand information, so we can see how a company is really performing. It helps measure things like profit, cash flow, efficiency, and financial stability. This makes it easier for managers, investors, and even lenders to evaluate the company's performance and make better decisions. Next is the types of financial ratio. First is profitability ratios. This shows how well a company makes a profit from its sale and asset. Then liquidity ratios. This shows whether the company can pay its short-term debt. Third is efficiency ratio, show how well the company uses its resources like inventory and equipment to generate sales. And lastly is solvency ratios. These show how well the company can handle long-term debt and stay financially stable. And finally, the benefit of financial ratio analysis. It helps company identify trends like rising costs, increasing debt, or changing profit. It also supports better decision making, helps control costs, plan sales growth strategies, and manage loan properly. Overall, financial ratio analysis helps companies stay stable, organized, and financially healthy, especially in a changing economy. And now I will pass to AZRI HAKIMI.
Thank you, NURAZRINAZ. The first one is liquidity ratios. The first ratios under this liquidity ratios is current ratio. The formula of current ratio is current asset divided by current liability. So in 2024, the current ratio for Padini Holdings Berhad is 4.38. So which means for every RM1 of current liability, the company has RM4.38 of its liquid asset to meet its obligations. While in 2025, the current ratio for the company is 4.52, which means for every RM1 of current liability, the company has RM4.52 of its liquid asset to meet the obligations. The second one is quick ratio. The formula for quick ratio is current asset minus inventories and divided by liabilities. In 2024, the quick ratio for the company is 3.32, which means for every RM1 of current liability, the company has RM3.32 of its liquid asset to meet its obligation without relying on inventories. While in 2025, the quick ratio for the Padini Holdings Berhad is 2.42, which means for every RM1 of current liability, the company has RM2.42 of its liquid asset to meet its obligation without relying on inventories. The last one under liquidity ratio is cash ratio. The formula of cash ratio is cash divided by current liability. So for 2024, the cash ratio for the Padini Holdings Berhad is 2.93, which means for every RM1 of current liability, the company has RM2.93 of its cash to meet its obligations. While in 2025, the cash ratio for the company is 2.84, and this means For every 1 ringgit of current liability, the company has 2 ringgit 84 cents of its cash to meet its obligation. The next one is profitability ratio, and one of the ratio under this big ratio is gross profit margin. The formula for gross profit margin is gross profit divided by sales and times with 100. In 2024, the gross profit margin for the company is 36.23%, which means the company generates 36 ringgit 23 cents of gross profit from 100 of sales, while in 2025, the company gross profit margin is 38.85%, which means the company generates 38 ringgit 85 cents of gross profit from 100 of sales. The next one is net profit margin. The formula for net profit margin is net profit divided by sales and then times with 100. In 2024, company's net profit margin is 7.64%, which means the company generates 6 ringgit and 64 cents of net profit from 100 of sales, while in 2025, the net profit margin for the company is 7.99%, which means the company generates 7 ringgit and 99 cents of net profit from 100 of sales. The third one is return on assets. The formula for return on assets is net profit divided by total assets and times with 100. In 2024, the return on assets of the company is 8.01%, which means the company generates 8 ringgit and 1 cents of net profit from 100 invested of total asset, while in 2025, the return on asset of the company is 7.55%, which means the company generates 7 ringgit and 55 cents of net profit from 100 ringgit invested of total assets. The last ratio under this profitability ratio is return on equity. So basically the formula is net profit divided by shareholders' equity and then times with 100. So in 2024, the return on equity of the company is 13.19%, which means Padini Holding Berhad generate 13 ringgit and 19 cents of profit for every 100 of shareholders' equity invested, while the next year, the company returns on equity is 13.06%, which means the company generates 13 ringgit and 6 cents of profit for every 100 of shareholders' equity invested. That's all from me. So I will pass to the next presenter, RAUDAH ADLEEN.
Thank you, HAKIMI. So next I will explain about the efficiency ratio. So firstly is inventory turnover. Inventory turnover is calculated by dividing cost of goods sold by inventory. So in 2024, the turnover was 4.25 times, meaning the company sold and replenished its inventory more than 4 times. In 2025, it decreased to 3.06 times, indicating that slower inventory movement, which may suggest lower sales or excess stock held during the year. So next is average collection period. So the average collection period is determined by dividing the account receivables by credit sales and multiplying by 365 days. So in 2024, the company took an average of 13 days to collect its receivables. In 2025, this improved to 11 days, showing faster collection and stronger credit control. Next is receivables turnover. So this is calculated by dividing the credit sales by the account receivables. So in 2024, Padini turnover was 27.25 times, meaning the company collected its receivables 27 times during the year. So in 2025, it increased to 32.08 times, reflecting faster collection and better cash flow management. So next, for total asset turnover is measured by dividing the sales by total assets. So in 2024, Padini's company generated RM1.05 cent in sales for every RM1 ringgit of their assets, while in 2025 this declined to 0.94 cent, indicating reduced efficiency in asset utilization. Lastly, under efficiency ratio is fixed asset turnover, which is calculated by dividing the sales by non-current assets. So in 2024, the Padini's company generated 2.97 in sales for every RM1 of their fixed asset. In 2025, it fell into RM2.29, showing that weaker efficiency in using their fixed asset, possibly due to the underutilization or slower sales growth compared to their asset expansion. So next, I'll pass to Fadhil HAZIQAH.
Thank you, Raudah. Now I will talk about leverage ratio. So first, we have debt ratio to measure how much the company assets are financed by debt. The formula is a total debt divided by total asset. So in 2024, Padini got 39.26% of assets were funded by borrowing, and in 2025, they increased to 42.24%, meaning Padini rely more on debt to grow its asset base. Next is debt to equity ratio. The formula is total debt divided by equity to compare the company's debt to its shareholder equity. So in 2024, they got 64.63% of debt used to compare with total equity. And then in 2025, they got 73.12% of debt per total of equity to show a sign of higher financial leverage. So next is time interest earned. The formula is earning before interest and tax, which is EBIT, divided by interest expenses. This to measure the company ability to meet its interest obligation from operating profit. The higher the ratio, the stronger ability to service debt. So in Padini, time interest and ratio is declined from 8.74 in 2024 to 8.21 times in 2025. While the company still comfortably cover its interest obligation, the drop reflects rising debt costs. Next, we analyze the trend of earning per share, or we call it as EPS. EPS dropped from 22 cents to 60 cents, despite higher profit in 2025. This decline due to a significant increase in the number of ordinary share issue, which is in 2024, 6.7.9 million shares, and in 2025, 986.9 million shares. The dilution effect means each share now earn less, even though total profit increased. Padini likely issue new share for expansion, acquisition, or capital raising. While this support long-term growth, it temporarily reduces shareholder earnings per unit. Investor and governance committee must assess whether the capital rise is generating proportional return, or if future EPS can recover through stronger earning or cost efficiency. Next, I will pass to next presenter, NURAZRINAZ.
So, to conclude, financial ratios are really important tools for understanding a company's financial health and performance. They help managers, investors, and stakeholders clearly see how a company is doing in areas like liquidity, profitability, efficiency, debt management, and overall value. By using financial ratio, we can understand whether a company can pay its debt, generate profit, use its resources efficiently, and manage its financial risk properly. This ratio also helps identify the company's strengths and weaknesses, which make decision making much easier. Overall, financial ratio plays a big role in planning, monitoring performance, and building long-term business sustainability. They help companies grow in a more stable, smart, and strategic way in a competitive business environment. So that's all from us. Thank you.